Siddhartha Bhaiya joins us now, Managing Director and Fund Manager with Aequitas Investment Consultancy. It's the first time I'm interacting with him, at least on the ETNA forum. Siddharth, nice to have you. Thank you for joining us. Tell us a bit about your current portfolio strategy. This is a market where I can endlessly argue about the macro concerns, and you will endlessly argue back by saying that don't worry what's happening in US, focus on what's happening in India, which is great. So let's not start with that argument. Let's start with portfolio strategy.
I think portfolio level, we've more or less largely invested. Last couple of months, we've kind of created a little bit of cash, 10% across portfolios, but nothing home. Again, as I said, you look at the global macro, the scenario looks really, really bad. You look at the domestic macro numbers, the numbers are very strong. So India is the only shining star in a very gloomy world right now. Right? Does the good news continue, or do things become, or do things take a little bit of a back turn from here? We let time decide. Okay. So as far as portfolio positioning is concerned, I think we are more or less, bullish on infra.
I think we've got him on a bad line. It's all right. These things happen. 5G is awaited. I hope really 5G comes very soon. You are underweight financials, and some would argue that that's a big contra call because it's very difficult to go underweight on financials when A, it's an heavyweight, and B, when such strong growth is staring at us in terms of an economic revival.
So I think I don't buy the argument that, while the economy is doing well, that the financials have to do well. This is the same argument that was given in 2007, that if the economy has to do well, infra has to do well, right? Financials in India, the weightage of financials has gone from 8%, 9% of Nifty to a peak of 44, 45%. No sector can have such high weightage, right? So I think going forward, my personal thing is that with interest rates increasing, banks are going to suffer losses on their treasury books. NPAs in a rising interest rate environment are definitely going to increase. So I'll be a little cautious. You've seen what has happened with Credit Suisse and Deutsche Bank worldwide, right? Every 10 years, some or the other major global banks collapses. So historically, if you look at it, financials have commanded lower P multiple. It's only in the last 10 years that the typical, traditional benchmark for valuing an NBFC was, say, 1 time price to book or 1.5 times price to book. And the bigger global banks got 2 times or 2.5 times. So I think valuations are still very, very expensive as far as the Indian financial sector is concerned. So that's the reason. Plus, given that we are headed into higher rates, NPAs are going to increase more so on the consumer side. So that's the reason why we are cautious as far as financials is concerned.
But you were saying, just a short while ago that you're bullish on the infrastructure theme, and I just want to stretch that point forward and understand how exactly it is that you're looking to play this basket in terms of if you could be a little bit more specific in with respect to the companies in the portfolio and what the outlook is in general for the infrastructure sector. What's driving the optimism?
So to be honest with you, infrastructure is not a luxury, it is a necessity. I just traveled from Mumbai to Pune last week, and there was barely any signal on the road. The traffic on the road was crazy. So we're looking at if we really have to achieve a GDP growth of 7-8% plus kind of this, we really need to spend a lot on infrastructure. So my sense is that, and with government revenue so strong, there is going to be a lot of impetus as far as infra is concerned. The valuations look very, very attractive for a lot of the infra and capital goods companies. And these are again stocks and sectors which were practically ignored for the last decade. So I think very difficult for me to discuss individual stock names, but look at the order book for some of these companies. They are at they have build to book ratio of close to 4 years with very little debt on their balance sheet. So there is scope for growth. And more importantly, we are seeing a lot of the bank credit now flow to the infrastructure sector. So I think infrastructure could be a big theme, not just for the next 2, 3, 4 years, but probably for the next decade.
Siddhartha, I'm tempted to talk about the top 5 stocks in your PMS, and let's start with Technocraft Industries. And while the auto demand, along with the supply chain issues, of course, is something which is known to just about everyone now. We've grappled with it for the last 1 year. But I just wanted to understand what makes you bullish on this company for a continued time to come.
Okay, so Technocraft, there are two major segments. One is drum closures. They have nearly 30% plus as far as the global drum closure market is concerned. That's a business which does more than 100% return on capital employed year after year. Second is they are into scaffolding. And given the growth, they're seeing very strong traction as far as scaffolding domestically is concerned. We are moving away from bamboos to steel scaffolding. So I think it's a market leader both as far as domestic scaffolding is concerned, and globally it's number 2 in the drum closure space. Company has very high return ratios, a lot of free cash generation, and is available at single digit P multiples. So we've been holding this share for a number of years now, to be honest with you. So all the top 5 that you see, most of them we are holding for more than 5 years. In some cases, we are holding them for 9 years. The stock.
My bad. I was confusing it with one of the auto angs. My bad here. I can see the entire list, and you've got a Gujarat Ambuja Exports, Technocraft, Deepak Fertilizers, Apar Industries, Methanol. When I look at names like Deepak Fertilizers, I wonder that it's a well-discovered story. Many wonder how much more headroom do some of these names would have going forward or not. I'm wondering whether you're looking at newer names to add here or reduce positions in the existing list.
See, typically we don't churn our portfolio a lot. Deepak is something which we've been holding for close to 10 years now, right? It is the largest manufacturer of technical ammonium nitrate in the country. It is the largest manufacturer of IPA in the country. It is the largest manufacturer of nitric acid in the country. And they've made a big investment as far as their ammonia plant is concerned, more than $500 million. The ammonia plant is nearly 6 months away. The kind of backward integration that this ammonia plant will give them and the kind of benefits that they're going to see in terms of raw material is going to be phenomenal. So we're a long-term investor. We've held for a number of years and good company, right? The balance sheet suffered a little bit during 2020, but now they're making truckloads of money. So we're just staying put at this point in time. Again, the valuations are attractive, sub 10 P multiple.
Your portfolio once again, just for the benefit of our viewers and those who track you. 6 stocks are there, and some of the stocks you've been holding from 6 years, Deepak Fertilizer you've been holding from 9 years. Gujarat Ambuja Exports, Technocraft, Deepak Fertilizer, Apar Industries and Methanol. Which out of these 5 stocks you plan to own for another 5 years? I mean, you said, look, doesn't matter, I'm not to sell them for 5 years because I see that kind of an earnings visibility.
Yeah, so to be honest with you, I wouldn't want to put that because that would really look as if I'm trying to, I don't want, we monitor our stocks on a quarterly basis, right? And practically on a daily basis, any news that is affecting our company. So while we can, some of these stocks have corrected more than 50%, 60% over the last 10 years, and not just once, but on numerous occasions. So we would have the patience, we would have the understanding to hold stocks through 50, 60, 70% drawdown, but not everyone does. So very difficult for me to say that, look, I'm going to hold this stock for the next 5 years. It doesn't work that way, right? This stock could double in the next 1 month and maybe we would be out of it for all you know. So we look at valuations, we look at the underlying fundamentals of the companies and then take a call.
M&M Financials is up 10%. Now the stock got hammered when RBI raised that red flag in terms of third-party collections. The number, the monthly update has come out where they're talking about increasing efficiency, or increased efficiency in terms of monthly collections. And Morgan Stanley has come out a report where they feel that the worst of the event risk is actually behind us. Mahindra & Mahindra Financials almost up 10%, no up 10%. 10% in a F&O market, it's circuit up, then the stock will have a cool-off period and then it will make a comeback. I don't see anything which has got to do with the urban consumption theme. I don't see anything which has got to do with technology. You don't have financials. So it's a very different portfolio where some would say that you're not betting on consumption, which is the India romance. You're not betting on Indian IT, which is the India provides. and you're not betting on banks, which is a secular story.
Right. So I think these are themes which have already played out over the last decade, right? Whether it is consumption, nobody wanted to touch consumption stocks at decade back. You have to look at where the flow of bank credit is going to go. Banking credit was flowing to to infrastructure, sector 10 years back. It was flowing to government stocks. Even on a day like yesterday, all you had was PSUs and infra stocks which were up. So that's a very, very strong indicator. Consumption stocks, the valuations are crazy. With interest rates rising, and with government being the biggest borrower, I think the government is going to crowd out the consumer. A lot of the consumerism over the last decade was driven by cheap credit. So I think that's going away. So that goes away. There could be a little bit of impact as far as consumerism is concerned. That's the only way to kill inflation, right? Is to kill consumption. So let's not fool ourselves by saying that this consumption story is going to continue. While it looks very, very strong right now, and it might continue, but at the same time, the valuations just don't leave anything on the table. There's no margin of safety.
What about the outlook on?
I know it's very contrarian.
No, sorry, go ahead.
I said my views are very contrarian.
I can tell. We're all doing a double take looking at that screen, but that's why I wanted to get in what the outlook is when it comes to the metal basket.
I think, metals globally, you're looking at metals are global, right? Commodities are global, and globally there's a massive, massive recession. So at this point in time, yes, the metal story is off for the time being.
Okay, so where to from here?
As I said, does India truly decouple, or have we seen the worst as far as the Western markets are concerned? I'm not clear. This is a time for consolidation. I do not expect a runaway bull market at any point in time. So I'd rather be cautious than be, very aggressive in this market. Let me put it this way.
Okay, point taken. Rather be cautious than be aggressive. Appreciate you taking the time out and look forward to seeing lots more of you on ET Now.